my time, you all I want. Neither of us wanna be alone.
Okay, g'day, Rudy here. Just another motley fool article. 3 low-cost ETFs to kickstart your investment journey. It's never been easier. Okay, ETFs, yeah. For those new to investing, low-cost ETFs, perfect way to kickstart. Yeah, tick, tick, tick. Give you diversification. Yeah, tick. No exposure to basket of assets in a single trade. Yep, tick. Fees are going down. Falling below 0.1%. Okay, so we've got IOZ charging 0.05% per annum, which is very cheap. And then back in the days, you're paying 1%. Back in the early days, anyway. The A200 ETF only charged 0.04, and VAS, the popular one to be promoted these days, it's only charging 0.07. So yeah, that's all good. So tick. I love ETFs. What I don't like is this stuff here. With VAS, the ETF has also been up more than 60% over 5 years. Wow. So if I'm a punter, I'm saying, see, that's cheap. I'm only paying 0.05. I'm paying nothing. And they're going to pay me. That's what they think. Or you might think when you see this. They're going to pay me 60% over 5 years. Wow, that's a great way to build my wealth. Then they go on about, will the fees go lower? And they probably will. But let's just have a look at this claim. 60% over 5 years. Okay, so I've got VAS here. Alright, so it's been a nice upward trend channel. I think it's where VAS has topped, the Australian market's topped, and it's going to do what it always does, which is not very much. I'll leave a video at the end of this one, which you can watch if you want to, which compares the Australian share market to all the other US, European, Japanese, emerging markets, and you'll see where the most boring index in the world to be invested in. But that's for another day, I guess. But yeah, I'm not that. And those other indices, ETFs they talked about, A200, IOZ, they all look the same. I mean, VAS is in the top 300 and the other two in the A200, but they're all basically a third financials, a third resources. So it's banks and financials. So we're just going to keep plodding along. But anyway, back to the 60%. Okay, so do you know how you would have had to got 60%? You would have had to bought in here in May 20, at the peak of when everyone would have been crapping their pants, and no one would have bought back then, not the punter. Okay, alright, so say you did that, you bought here, and then you sold up here. Well, there's the number. It's not even, there's 57%. So they're saying you can make 60% over 5 years. Well, the average punter would definitely, because the market, everyone would be saying, oh, the market's going to fall over. And it wouldn't have been until probably back here that everyone would be saying, oh yeah, the share market's a good place to be. So let's see how. And it wouldn't. So here, back in time, they're going, oh, the share market's making new highs. Okay, so everybody jumps in. So say you jumped in there. So that's only about this is 4 years. So you went in 4 years ago. That didn't work. Let me just do that again. Sorry about that. So you jumped in here. And you jumped out, and then you're in there. So over the last 4 years, you would have made 20%. Now that's a lot different to 60%. And if you're like a punter who got in here on November 21, well, here we are, March 25, and you haven't made anything. So yeah, that's so part of the point of my story is passive ETF index investing isn't the be all and end all, because they do go up and down, and you just can't invest for 5 years and make 60%. I do believe in ETFs, but you got to just look outside of Australia and watch the video that's going to come after this one. Alright, let us know what you think. So
Never waste my time. You all I want. Neither of us wanna be